with very low interest rates for home mortgages. Low, I guess a 6-year low, 203 would be the, you have to go back to that to hit the rates we're seeing now of average rate around 4 7/8% for an owner-occupied loan, up to the conforming loan limit of $417,000. That's down about a percentage point from 6 weeks ago, 8 weeks ago, and the difference, if you did borrow $417,000 at 4 7/8 versus 5 7/8, you're saving about $260 a month. So 4 7/8 you pay. This is at $417,000 on a 30-year fix. 4 7/8 you pay $2,207. At 5 7/8 you pay $2,467. A big enough amount change or interest rate change and payment change, it has triggered a really kind of a boomlet, I guess I would call it, in loan demand. And what we're seeing is in week ending, let's see, statistic I saw was the week ending December 19th, mortgage loan applications were up 124% versus that same week the year before, the conclusion at 207. So what you will find if you are involved in an escrow or a refinance for yourself is there's a backlog to some degree, and whereas as a mortgage broker we would submit a loan package and have a response in 2-3 business days, now it's 2-3 weeks to get a loan approval. So one has to adjust. It's a couple of weeks longer to get through the process, but of course, as we'll take it. You know, we're happy to have that lower interest rate. Of the mortgage loan applications, 83% in the same week as the statistic I read, week ending late December, of the loan applications, 83% of them were for refinances, meaning 17% were purchase deals. And I love this statistic. Fixed rate loan applications versus ARM loan applications. Anybody want to guess what the ARM loan application percentage was?
2%.
Somebody said 1%. That was actually less, 0.08% for ARM loans. So not a lot of adjustable rate mortgages being applied for, really it's the marketplace just isn't making them attractive at all. It's all 30-year fixed rate loans now. Why? Okay, where are we? The government is subsidizing, in effect, 30-year fixed rate, owner-occupied, single-family, and condo home rate. That's where the subsidy is. That's where the U.S. government is throwing its weight in financial wherewithal. And what that means for us in this room as investor-oriented, real estate people is that the 2 to 4 unit property, it's not getting this push, this deployment of U.S. capital, treasury funds. It's not going into non-owner occupied monies. So you're going to be over 6% on a fourplex, non-owner occupied, on a duplex, non-owner occupied. And that's just where it is. So we're not getting that additional government support. That's another discussion. Is that a good thing? Is that a bad thing? But that is the policy at present. What we are dealing with now is, just the rest of the market, the open market, the free market in terms of capital isn't confident enough, I guess, to deploy itself into investment real estate loans. Not there yet. And we continue to see headlines today, or little caption headlines I see, bankruptcies up 32% in 2008. Over 1 million people filed bankruptcy in 2008 versus 2007. Auto sales, of course, no surprise, auto sales, they were off 30%. Auto sales in the U.S. were off 30% in 2008 versus 2007. Chrysler in December off 53% sales. As we continue to see headlines and captions like that, it's not bringing lenders back into that confidence level that they need to go ahead and push money out into the economy. in terms of real estate lending. What are we seeing in terms of apartment loan money? Well, there's a differential that has grown between the home rates and apartment rates. And I see, and the money rate scoreboard reflects, apartment rates 6 3/4 to roughly 7 1/4, 5 to 10 year terms. Not horrible, but not what we would like to see to really move this market forward. You'd love to see what we're seeing on the single family side, which is this decline. If you had a 5% apartment rate, boy, that would be appealing to, I think, to investors, and not there yet. Now, we do have rates that were pushed down another 0.75% just after our last meeting at REOC. So late mid-December, December 17th, government pushed its short-term rates down 0.75%, leaving the Fed funds rate right at about quarter percentage point is the Fed funds rate. Bank prime 3 1/4. So the rates can't go any lower, really, and that the Federal Reserve does not really have any more ammunition to push rates down, and whatever subsidies, whatever help the Federal Reserve is going to be now, it really can't be in lower interest rates. They have to go in other directions, and which is lending money out in some way, shape, or form, and subsidize or providing money to banks so that they can make the loans. And this is what I conclude on, Jim, is where are we in terms of banks? When will capital come back to our markets? Because it's just not there and anywhere near the volume that it was 2 years ago and 3 years ago and before. Loans that when the lender is asked to make a loan, well, that loan now, as opposed to 2 years ago, it has to underwrite properly. It has to, the mathematics of the loan have to make sense. It wasn't that way a couple years ago. Now they're going to make us prove that there is a very viable payback scenario on every loan. So you can't expect a lender to make a loan if they're not real confident that the money's going to be paid back. So that's a healthy thing, I think. And then investors that had been investing in loans, pension funds, portfolio managers, hedge funds, they have to believe in the financial statements of the borrowers. Talking about if they buy bank paper, for instance, they have to believe that what Moody's and Standard & Poor's and Fitch are reporting as the financial statement, they really have to have confidence that that's accurate. And I think they've lost that confidence. Even though Standard & Poor's says it's a B+ rated bond, just doesn't carry the same credibility that it did a couple of years ago. Unfortunately, it's going to take some time to build that confidence back. And when we as a society do adjust our lifestyles, and I think we're still in transition to kind of a new paradigm, this new world of 2008, 2009, and the way financial markets are, the way our economy is, as we adjust, we start, our spending habits kind of resolve, and we redeploy our funds into more of the necessities versus the non-necessity purchases. As that settles in, I think that's the part where the lending arm of our society says, oh, good, I can kind of understand what Americans are doing now, and I think that'll bring the money back into our economy. So we need to finish off this transition, regain some confidence that we can really rely on the financial statements we're reading, and that's the traction point for us. And I hope that's in 2009 as early as possible. Thank you all for your attention this morning. We'll see you next.